Welcome to Chapter 8. In this chapter we deal with flexible budgets and standard costs. We just finished Chapter 7 where we looked at the master budget. Now we're going to look at a flexible budget, and why do we need a flexible budget if we have a master budget? Well, let's think about it. We've just gone through a process, the end of the year, where we've set our master budget for the upcoming year. Well, typically, especially in these last 3 or 4 years with all of the financial uncertainty and the crisis worldwide, what we know is that as soon as we developed our master budget, maybe 3 months later, it may not be totally useless, but there's a lot of parts of it that are no longer valid. So what we do with the flexible budget that we introduce this concept in this Chapter 8 is that what we're doing now is we're saying, okay, if we look at our master budget volume and we compare it with our actual volumes, it's not often they're going to agree. So if we don't adjust our master budget to our actual volume, we will be comparing apples and oranges. So that's kind of the top line, the first step. The second step then is we take it down to more detail and we look at our budget on each particular item if we're a manufacturer. We look at our direct materials, our direct labor, and our factory overhead, because we will be setting standards for each one. There will be 2 standards set for each one. We'll have the quantity, like the number of pounds of material, the number of labor hours, and we'll have the dollar, which is the cost of each of these, and that's how we will develop our standards down at the lowest level of making the product and then taking it all the way up. So now if we go to slide 6, again as a way of refreshing, step 1 is we develop the overall master budget, and we covered that in Chapter 7. Now step 2 is, and here's where we move into Chapter 8, we compare the actual with the budget and we analyze the differences. And here what we will do is we'll take our flexible budget, it becomes our master budget adjusted to the actual level of activity, and then we compare it to our actual costs for that activity level so that we're comparing, again, apples and apples. Third step of the budget and budget control process is that we look at the differences, our deviations from our expected results, we take corrective and strategic action, and then 4, we use this information to help us prepare the new budget for the following year. So if we look at then slide 7, we're going to move to, and you'll notice here we have this organization. The fixed budget, which was the master budget, was based on 10,000 units, but we actually had 12,000 units sold. Well, if we compared these two, we're going to be comparing apples to oranges. We ought to take our master budget, move it up to 12,000 units, and then ask ourselves the question, what should we have spent if our budget was at 12,000 units instead of 10,000? So then we go to slide 9. What we see is that, okay, so this summarizes then the purposes of our budgets. Essentially, we're showing revenues and expenses that should have occurred at the actual level of activity. Therefore, we can adjust our budget. We can adjust our master budget to any level of activity within the relevant range. And then we look at the variances that occur. We try to analyze why they occurred and then improve the operation. So let's move to the standard costs in slide 17. And what we're going to do here in slide 17 is we're going to look at our standards where we will set a standard price and a standard quantity in labor, material, and overhead for each product that we manufacture. And if we jump ahead then to slide 19, we look at that and we see that we have price standards and quantity standards, again, just further emphasizing what we've stated before. So now we jump ahead to slide 28 and we will see how we compute the variances. And notice we'll have two types of standard cost variances. We'll have our price variance, which is the difference between the actual price and the standard price. So, for example, if we thought we were going to spend $10 an hour for our direct labor, that was our standard price, and we spent $12. Actually, we want to know why did we spend $2 more. On the other hand, we have the quantity variance, and here we would be analyzing, we thought we were going to use 1,000 labor hours this month. We actually used 1,100 labor hours. Why did we use more labor hours than we originally thought? We look then at slide 31, and then we see actually how we compute the variances. And we set up a 3-column approach. We have the actual, and we do this for each of direct material and direct labor and variable overhead. We'll have our actual quantity times the actual price on the left-hand column. In the center column, we have the actual quantity times the standard price. And in the far right column, we have the standard quantity times the standard price. Our variance on the left will always be the price variance. Our variance on the right will always be our quantity variance. This is a slide that I recommend that you make sure you have a copy of, can access it, because this will help you in your computation of variances. So then if we look at slide 32, we look at the labor variances, and again, here we have the same 3-column approach, the actual quantity. Well, the way we measure quantity in labor is through labor hours. So we have the actual hours times the actual rate, the middle column the same, and the far right column the same. So then if we look at slide 33, we now then start looking at why did we get negative or unfavorable variances. Well, there could be four major reasons. We could have poorly trained workers, poor supervision, poor quality materials, poorly maintained equipment. A lot of times what happens is our purchasing department goes out and finds a new material that we could substitute for an existing material, and we can get it for a cheaper price. Well, everybody's interested in reducing costs. So we go out and we buy this new material. We save money on the cost of the material, but that material, because it might not be as good a quality, could cost us in that we now have to use more labor hours because we have more rework, we have more problems that come about. So again, we now can focus on, and we can answer the question, was it worthwhile to buy this lower quality, cheaper material than it was to use the higher quality, higher price material? So if we then go to slide 34, notice here we come back to a term that was introduced in Chapter 2, our predetermined overhead rate. And then in Chapter 4, we decided whether it was going to be the single plant-wide rate, the departmental rate, or the activity costing rate. So we're now back to this concept, which again I want to reemphasize for you. This course builds on itself from the very first chapter. It's difficult just to take one chapter in this book and isolate it, and then without having all of the prior chapters leading up to it. So here again, as I pointed out, we have this concept of the predetermined overhead rate, which was introduced in Chapter 2. So if we then move to slide 36, what you'll see is, again, we have the actual variable overhead incurred. So in overhead, we have the actual costs on the left, the flexible budget in the center, and the standard on the right. And then if we look at slide 37, we have our final variance of the fixed overhead, which is a slightly different three-column approach. We have our actual fixed overhead on the left, our master budget in the center, and our flexible budget on the right. So with that now, what we've looked at in this chapter, we've looked at the need for having a flexible budget. Having a master budget is no longer sufficient by itself. We need a flexible budget, realizing that our budget goes all the way down to the lowest area in a department, in a company. We take it down to how many hours of labor does it cost to make an item, and what do each of the material components cost, and we build that up all the way up to the master budget.